What's really interesting is that the HEROES Act, which was passed by the House of Representatives back in May, has some important line items, including state and local government spending. Now, what Jay Powell has stressed over and over again is that government jobs matter. They comprise 13% of the labor market, and so it's important to give that needed funding to state and local governments, many of which are under tremendous pressure, especially budget requirements. So impacted by the pandemic. Reasons, but they certainly complement each other and should be part of a diversified fixed income sleeve in a portfolio.
Christine Hooper of Invesco, thank you as always. Always need more time there. Too short as always. Coming up, the market movement events you need to be watching. It's next in our trading diary. This is Bloomberg.
When I try to raise my voice, instead of being applauded for strong leadership, I was criticized for it. I made it to the table, but I was still expected to conform to gender stereotype. Just to give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off field.
This is Bloomberg's The Open. I'm Taylor Riggs in for Jonathan. For a quick look at where these markets are. We opened just less than 30 minutes ago. We had a great durable goods orders this morning. Underneath the surface, though, it does look like most, as Mike McKee was telling us, auto sales here. So some underlying cracks, of course, still beneath those headline numbers, but that is not affecting the markets. The Dow rolling over just a little bit, but the S&P expands again an additional 4 points as we get more days, more record highs. Time now for the trading diary, what you need to be watching this week, and it's a big one because at the top of the hour, Richmond Fed President Thomas Barkin speaking, President Trump meeting with medical professionals at 3 p.m., and it's the third night of the Republican National Convention. Another round of those big, high-frequency jobless claims on Thursday, plus the main event. It is Fed Chair Jay Powell. He is speaking at Jackson Hole. And then, of course, it will be U.S. personal income and spending on Friday. Big week, and we'll be hearing, of course, not only on those jobless claims, the big live event from Jay Powell is the big one that all market participants are watching. I hate to say it, I'm a broken record another day. Now, more record highs. You do have a little bit of lift, though, on the 10-year yields. We're up to about 7 basis points or so, 70 basis points or so. Much more next. This is Bloomberg.
Interactive Brokers charges 1.59% for a $100,000 margin loan. You know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% in E-Trade or Ameritrade. Move your account to Interactive Brokers. Save at least $5,200 or much more if you're trading big bucks.
I'm really interested in working with artists that are at the forefront of various social urgencies.
We are trying to break the borders between technology, art, and law.
Where's the role of artists as interventionists, trying to change the paradigm?
It's about highlighting these inequalities and then also trying to come back to solutions to change.
Hyundai Motor, connecting art and technology.
Safety and support to those who need it isn't safe until every one of us is.
Three p.m. in London, 10 a.m. in New York, 30 minutes into the trade day in the United States. From London, I'm Guy Johnson with my co-host in New York, Katie Lyons. And it kind of feels a little quiet ahead of Jackson Hole. I know we're pushing up to fresh record highs on the S&P. We see do that on a daily basis.
Looking at markets, watching and waiting for Jackson Hole tomorrow. What are we going to get in terms of timing and commentary on the Fed's approach to new policy, new inflation targeting? The S&P, of course, as you mentioned, making a fresh record, but not a huge move up, just about 0.2%. The relative outperformance yet again comes from the Nasdaq, higher by 0.6%. That relative underperformance coming from the Dow. Ahead of Jackson Hole, we're looking at a 10-year yield hovering right around 70 basis points. And Guy, I continue to have my eye on oil. WTI futures up only 0.4%, despite the fact the Category 3, possibly Category 4 hurricane barreling toward the Gulf and all of the refineries, oil production that goes on in that region. So we will continue to keep an eye on that and talk more about oil, the energy space, and of course, what the potential 2020 race has to do with it in climate policy. We'll do that with Melanie Nakagawa of Princeville Capital. She is the Director of Climate Strategy over there. But first, we're going to turn our attention to the Fed. Of course, the big event of this week, markets are waiting and watching. The Kansas City Fed's annual economic policy symposium kicks off in Jackson, Wyoming tomorrow. It's going to be virtual this year, as we know, but the theme is navigating the decade ahead, implications for monetary policy. Well, Kansas City Fed President George spoke with Bloomberg's Michael McKee ahead of that gathering.
I will just offer you from my perspective that this has been, I think, a useful process. It's been a process that really asked of ourselves to the economy may have changed, and importantly, to think about how we communicate to the public. So the process in and of itself, I think, has been a useful one, and I will leave to the chairman to talk about what we've learned from that.
Well, you've been considered an inflation hawk. Where are you on this idea of average inflation targeting?
So my focus on inflation, Mike, as you know, is to be true to our price stability mandate, that our 2% target really has to represent what's happening in the real economy. And so as we think about ways to better communicate to the public, I've never thought of 2% as inflation expectations in the economy. So from a communication standpoint, I think we will be talking about the kinds of things that help us do a better job of achieving our objectives.
Wall Street's betting, or at least many people on Wall Street are betting, that the Fed will change its forward guidance in September. Some of your colleagues say don't need to do that yet. Where are you?
In terms of interest rate policy, in terms of asset purchases, and the credit facilities we've had, I think trying to gauge what else does the economy need is probably premature. I think we are beginning to see signs of a recovery. We're beginning to see where the economy may have shortfalls, where it may be doing okay, but that is going to take some time. So thinking about what those other things are, I think has been a useful discussion. Whether it's time to activate those things.
In the financial community, economy is perhaps an inflation danger down the road?
Well, as a central banker, I think we always keep our eyes on inflation and what impetus may point that the economy regains its footing. And we'll have to look and see what impact we see through prices at that point. But today is probably not that day.
Well, let's talk.
Greece has experienced the virus in different time frames and different levels of spread over the last 5 months. And what we see overall is there has been some improvement in the job market. Of course, that's coming back from a very low level. Particular to this region, of course, things like agriculture and energy are very prominent. We know the farm sector has been under some stress for some time with low farm incomes, and this episode puts further stress on that, causing the farm sector to have to rely more heavily, for example, on government supports. Energy, too, with the rapid decline in oil prices, productivity, the producers had to lay down their rigs. So those two sectors in particular in our region already under some stress. It will take some time to come back.
If I could ask you to expand on the labor market. What are employers telling you right now? Do they need more people? Can they find more people? Or are they just sitting back at this point and saying, we have to wait and see where the economy goes?
So we hear a variety of things that won't surprise you, but very important as we talk to our contacts in the time, and bringing people back in those sectors looks to be some time away. We also hear that some are having a hard time bringing people back because they felt like they were competing with some of the jobless benefits. Whether that's true today is less clear. So there are a number of dynamics that are affecting that labor market. And that, of course, is why it will take us some time to see where does all of this shake out in terms of how that labor market heals and how we begin to see growth resume in the economy.
That was, of course, Esther George, Kansas City Fed President, speaking to Bloomberg's Mike McKee ahead of Jackson Hole. Mike Feroli joins us now, JP Morgan chief US economist, to give us his take. Michael, what are you expecting from Mr. Powell tomorrow?
Targeting, which would invite an overshoot of the 2% inflation target. But I think the rest of the committee is probably on board as well. I think that will be the most significant thing that we'll hear from him. I think also consistent with Esther George's comments there, we probably won't hear much about an imminent shift toward new forward guidance, which I think we and many others had expected at the September meeting, but certainly there has been some pushback from various regional bank presidents, as well as what we heard in the minutes last week. So I think the more important thing we're going to hear tomorrow, again, is an update of this framework review and a preview of the conclusions. Yet the formal conclusions I don't expect until the September FOMC meeting, but I think Powell will basically essentially give us those conclusions, even if it's not formally revealed until September.
Well, Michael, I want to take up on your first point there, which is this inflation targeting. I want to ask you about the communication factor here, because a 2% target, very easy for mom and pop, the average American, because a 2% target, very easy for mom and pop, the average American, to understand. Average inflation targeting may be less so. How does the Fed approach that communication challenge?
Right, so I think the simplest thing to say is that they want to achieve 2% inflation on average over the business cycle, rather than trying to hit 2% at any time and let bygones be bygones. Again, whether that's going to be well understood.
Michael, how long do US rates stay at virtually zero? The equity markets obviously is pricing off this. Everybody's trying to work out the answer to that question. There's a Bloomberg story today talking about basically rates remaining where they are now for roughly 5 years. Does that kind of jive with what you expect and what you think will happen?
That seems about right. I mean, my official forecast only extends to the end of next year. But when you think about when we can sustainably achieve 2% inflation, which presumably will be a precondition for the first rate hike, that could be several years in the future. So 5 years, as a ballpark number, that seems about right to me in terms of when we can actually generate higher inflation. In the previous segment, you talked a little bit about this debate on inflation and whether we could actually see some inflation more sooner than that. Certainly in July, we had a nice pop in inflation. However, I think as we settle into more of a normal, slower recovery, I expect the disinflationary forces will predominate. And for that reason, I think it's going to be quite some time before we actually see 2% inflation. So I would expect rates to be at this level for quite some time.
But are those disinflationary forces powerful enough to offset this unprecedented wave of fiscal and monetary stimulus we've gotten at this point, Michael?
So on the unprecedented fiscal, you're right that it has been quite impressive. However, a lot of that was really paid out in the second quarter of this year. We're actually, if anything, undergoing a bit of a fiscal cliff right now as some of the effects of PPP, expanded unemployment benefits, some of these things are rolling off. So if anything, we're experiencing a bit of fiscal drag in, I think, the second half of the year and on into next year. And then on the unprecedented monetary stimulus, monetary policy is definitely stimulative, but for this framework review is that the neutral rate of interest is very low. So having stimulative as we thought it was 5 or 10 years ago. So for that reason, we are getting support here from both fiscal and monetary policy, but it might not be quite as much as it appears on face value.
In terms of what you're seeing with the data right now, Michael, we've just seen a very strong durables number. That has a pretty noisy series. What are you getting from the other data series that you're following, particularly the kind of the alternative data series as well? Where is the US economy right now?
Right, so durables obviously relate to the manufacturing sector. Manufacturing, I think, is having a very strong rebound into the third quarter, partly on strong consumer demand for goods, partly on an inventory rebuilding effort. We're seeing support in tech. I think we saw that even in this morning's numbers. So manufacturing is one sector of the economy that was very strong. Housing, everything we see in housing was very strong, supported by very low mortgage rates. I think the bigger question comes in consumers. Some of the high frequent our internal card data, for example, suggests that consumer spending growth is slowing in August. It's not contracting, at least the best we can tell, in July consumer spending, maybe moderating. And so I think that's the big area of uncertainty is where consumer spending goes. Manufacturing, housing look great, but consumer is obviously the biggest part of final demand. And that's looking a little more questionable, I think, in part because of, as I just mentioned, some of the withdrawal of fiscal after having received a lot of support over the prior few months. And right now, I think the jury's still out, and the high frequency indicators are suggesting, not a
recovery than just getting past the pandemic itself. What are your thoughts there?
So I think that's absolutely right. I would agree that one of the reasons why we wouldn't look for a complete V in this recovery is that you are going to have these reallocation costs of moving people from jobs that no longer really exist into different sectors of the economy that are expanding, and that's going to take time to retool the skills and training for those types of part of the economy. It's 2/3 of consumer spending is in services, so it's not like we're talking about something that is an afterthought. So, and it's an even greater share of employment given the lower average productivity in service sectors. So, by far, I think this is the big challenge that we're looking at right now. So, by far, I think this is the big challenge that we're looking at right now. When I mentioned that, where we're thinking about consumer spending as being the area, the question mark on the economy, it's really consumer spending on services. Consumer spending on goods has been doing quite well, supported by pent-up demand, demand for home tech products, things of that nature. So it's really services that I think is the major question mark for the overall economy.
Michael, what will be the implications of Washington failing to deliver another stimulus package?
So that obviously would be a negative development. I think we and most other forecasters have been expecting a pretty substantial further stimulus effort, in part just to smooth off that fiscal cliff from the second quarter to third quarter. Without that, the economy may still, the recovery most likely will continue, but I think having the added insurance of a little bit more stimulus would be helpful. So I think right now, if we don't get that, I would be inclined to think that in the fourth quarter, in particular, could look, closer to flattish type of GDP numbers rather than. I think everyone already has a very strong double-digit third quarter GDP number penciled in, but without further fiscal support, I think the fourth quarter starts to look maybe closer to a flat type number on GDP.
Well, what perhaps could provide a bit more impetus for Washington to get it together on the next fiscal package is a deterioration in economic data. And we get a slew of it tomorrow, including that second read on 2Q GDP. Also, initial jobless claims were surprised to the downside last week. What are you expecting tomorrow?
So we're looking for some modest improvement in jobless claims relative to what we saw last week. I think in the GDP numbers, not big revisions relative to -33 number we got on the first print. I think it will be interesting. This is going to be the first look we have at second quarter profits, which we're expecting to be down pretty significantly. So I think that'll be an interesting detail in tomorrow's numbers.
All right, Michael Feroli, we have to leave it there, but thank you for giving us so much of your time, JP Morgan Chief U.S. Economist. Thank you for joining us. This is Bloomberg.
Really important to understand the different types of coronavirus tests. Antibody testing detects antibodies against the coronavirus that show that you had the infection in the past. So this really gives us an indication of someone who has been infected and who is now recovered. Has fought off various viral or bacterial infections in the past. Those antibodies, 10, 15, 20% of the population, more broadly than just the antibody test when we talk about what are the things we need to go back to work. We have very little antibody testing that's FDA approved in the world that are being tried out. Most of this work is happening in the setting of trials and clinical research. So antibody testing could be useful, but social distancing will remain important. Availability to test for active infection and contacts will remain important. So antibody testing, I don't think will be by itself a solution. It's one piece, one tool in the public health toolkit.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Risky Gupta. US orders for durable goods were surprisingly strong last month. They rose 11.2%. That was more than twice the estimate, and it indicates that factories will have. He says the results suggest that Nordstrom remains disadvantaged in a work from home, limited social event world. And the investigation into the behavior of former McDonald's CEO Steve Easterbrook has expanded. Bloomberg's learned the company now wants to know whether Easterbrook covered up improprieties by other McDonald's workers. The fast food chain has sued Easterbrook to claw back his severance. He has denied claims he was involved in affairs with multiple employees. Shares of Salesforce are rising today. The software maker topped quarterly revenue and profit estimates. That's considered a sign that many corporate customers responded to the economic slump by upgrading critical technology systems. Salesforce also raised its annual revenue forecast. And that's your Bloomberg Business Flash, Kaylee.
Britta, thank you. Well, this is a classic debate, active or passive. Of course, the popularity of index funds has put greater pressure on those active strategies. Well, Jenny Johnson, Franklin Templeton president and CEO, spoke with Bloomberg's very own Scarlett Flew on Bloomberg Front Row about where active managers add value.
Passive tends to do very well in momentum markets, right? It's a market cap weighted. And I want to talk about this from an equity standpoint and then a fixed income standpoint. So from an equity standpoint, you have 6 stocks in the S&P 500 that has, basically generated 10 times the return of the rest of the S&P 500, right? So if you were an active manager and you underweighted any one of those 6, it probably didn't matter that you got the sector bets or the individual stock bets in the other sectors, right? Because there was such a barbell as far as returns. I don't think that carries forward at the same level. And so, we look at it, just today I was having a conversation with our biotech team, and, we have PhD scientists on our biotech team. And you think about all the companies that right now are talking about the vaccines that they're now developing and how that's impacting their market cap. Well, the biotech team's coming to me with Jenny, good science is what translates into good returns. You have to understand the approach on these. That's fundamental analysis. That's having people who are so steeped in individual sectors and understanding behind them that they can make those picks. I think that becomes very important going forward. And then I just say on the fixed income side, look, the fact, if you just think conceptually that passive fixed income is about when companies take on more debt, you're increasing your exposure. That just doesn't make sense, right? It's a dangerous way to have an investment strategy. I know our Muni group, and talking to them when COVID hit, and they had the benefit of understanding already the credit worthiness of various states and municipalities, and then they could pivot when they looked at it and said, "Wow, this is going to impact certain sectors are very vulnerable to this: healthcare, transportation, and other sectors are immune." So they can pivot their investment strategy to take advantage of those moments very quickly because they have that deep understanding.
I get the deep understanding, and certainly on the equity side, the ability to do the detailed analysis is invaluable. But I wonder how much of it comes down to human versus machine, because you've got better technology, you've got systematic strategies, all of which have shown that humans are not very good necessarily at consistently picking winning securities over the longer term. I mean, that's just kind of what the numbers bear out. So over the longer term, does technology win out?
Yeah, no, so I tend to view it as it's a hybrid. The data is going to be very, very important. But here's what data doesn't tell you. When something externally changes, the Fed changes their policy, the policy, there's some regulation that comes in. You have to have the combination of both people and data. And that's where I think active management is evolving, where you're bringing those two things together.
Do you think we'll see the move from active to passive slow or stop in the next couple of years?
Yeah. The big question that I think is with the percentage of passive, does that become kind of a self-fulfilling prophecy? It's fast on the way up, and we saw it in those couple of months. On the way down, it's even faster, right? There's no buy bid on the passive model. On the way down, active's going to shine as the next decade's going to look very different from the last. And there's a lot of sensitivities that companies are going to have to be able to maneuver, including supply chains. And so being able to fundamentally get under the covers and understand the impact that these types of decisions is going to be important. And then, of course, ESG, I think, is an area that you benefit from active management.
Jenny Johnson, Franklin Templeton President and CEO, speaking to Bloomberg's Scott for passive versus active. Talking of active, coming up, Hurricane Laura rapidly intensifying. We potentially could be looking at a Cat 4 hurricane. This is a live shot you've got as we await landfall. What is interesting, Kaylee, is at the moment, oil price is not up by much. We're up by 0.6% on WTI. Harry Chungarian is going to be joining us a little later to discuss all of this. From BNP Paribas, he's the head of commodity research. Kate.
Well, guys, just a quick check on the markets here. We are looking at fresh record highs yet again on the S&P 500 and the NASDAQ, while the Dow lags for a second day. Within the S&P 500, it is a tech and communication services outperformance story. Salesforce, Microsoft, Facebook leading the way higher. And in the bond market, we're looking at a 10-year yield hovering right around 70 basis points ahead of Jackson Hole tomorrow. As you mentioned, not a huge move in crude. Stay with us. This is Bloomberg.
Soothing music is something that we particularly adept at as a very refined and great musician. Serving the public is a little trickier. How did you get a read on that? You don't get Nielsen ratings. How did you have a sense of what would serve the public, what they would react to? And then you get everything synced. My view is an orchestra and Carnegie Hall, a great hall, has to behave like an artist. It has to think in terms of what are the really important stories we want to tell? What are the really important things we want to present? How do we give people the most amazing experience? So it's all driven by that. It's not about market research and what do the audience want? Because if you do that, you're always looking backwards. And it's like Steve Jobs. People always say that. People don't know what I want to give them tomorrow. I've got to actually create it and then engage. They can't live without it. It's exactly the same in the arts. You've always got to be about tomorrow. If you do anything by audience research, you will always be looking backwards by definition, which is a waste of time. It has to be about service. It has to be about how you serve the music, how you serve people through music. Instead of being about how do we make the quickest buck today and tomorrow, it was always about how do we take long-term decisions that are actually going to really put us in the right place.
Helping them also with some surgical masks. That was some of the latest discussions that we had, and open up some new capacity to make those. We're continuing to have discussions and trying to help the country in any way that we possibly can.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
From London, I'm Guy Johnson, Kaylee Lines in New York, Alex Steele off this week. You're watching Bloomberg Markets. Kaylee, let's turn to what's happening in the crude market and also what's happening in the Gulf. First of all, let's deal with the data we're getting from the EI. Has yet to hit my screen. Give it a few seconds. We're not quite at past yet. And when we get those numbers, we are expecting a draw, and it's a bigger draw than anticipated. 4.6 million barrels, the draw, that's significantly larger than anticipated. Gasoline inventories also a significantly bigger draw than anticipated. So we are getting a little bit of a surprise out of the crude market, but all eyes, to be brutally honest, focused on what is happening with the Gulf as we await the arrival of Hurricane Laura. Cat 3 now, potentially Cat 4. Cat 4 is a big hurricane and could potentially provide refinery outages for many weeks to come. Harry Chilingari of BNP Paribas, Head of Commodity Market Research, joining us now. Harry, first of all, just your quick reaction to the data.
On the headline, I think it's fairly constructive in terms of the declines in crude stocks and gasoline stocks. Of course, we'll have to go into the detail into what is driving the declines, but I think certainly from the headline point of view, it's relatively constructive, but largely anticipated. So even if the numbers are a little bit bigger than what the Bloomberg survey was indicating, I think directionally this was more or less already in the price. But nonetheless, a constructive report.
All right, well, Harry, as Guy alluded to, we can't ignore the giant elephant or storm in the Gulf set to make landfall tomorrow. You already have 80% of oil production in the Gulf closed, about a third of capacity. Some estimate that 12% of U.S. refining capacity could be offline for as long as 6 months. Is $43 a barrel for WTI appropriately pricing that risk?
I think it's still a little bit premature. I mean, the weather system, Laura, still have to make landfall on the U.S. Gulf Coast, and of course it's been gaining in strength, and now looking to be categorized as a level 4 weather system. It really depends on whether or not we're going to have damage to infrastructure and the extent of flooding. So a number of refineries have shut down on a precautionary basis, and if they have done a full shutdown or are running at reduced rates, if there's no infrastructure damage, we've got to see those operations returning swiftly. Same could be set up for our making data as to how long plants and operations are going to be out. We'll have to look at what happens to the weather system when it makes landfall. Typically, when this happens, the winds decelerate, and we'll just have to see from there. Otherwise, I mean, even with the declines in inventories we had in the EIA report, we have substantial amount of buffer when it comes to oil stocks, especially in crude and gasoline. So even if production is off for longer or refineries are shut down for longer, you do have the ability to continue to supply the market.
Harry, how do you overlap what is happening with COVID and the impact that it's having on demand and a storm like Laura? Clearly, one is positive prices, one is trying to work out how you those two factors.
Versus a sort of longer to medium-term impact. In the case of outages that are weather-related, again, depending on the infrastructure damage and amount of flooding, we're going to see an impact that could last anywhere from a week to several weeks. On the other hand, COVID, the evolution of COVID, and especially our efforts in developing vaccines and therapies, all those sort of lend themselves to a longer time evolution of COVID and our ability to contain secondary waves in terms of outbreaks and manage those waves. And if we do, then the global economy will continue to recover, perhaps uneven with the prices. The weather events, again, depending on severity of their impact, it could be anything between a week to several weeks before things in terms of the weather. And then, of course, the global macro, COVID, OPEC plus, that's more for a couple of quarters to come ahead of us.
Obviously, there are a lot of competing factors at work here, but as the market weighs all of that, we've really been in this range of $40 to $45 a barrel for really several months now. What do we need to break us out of that, either to the up or downside?
Well, we're definitely looking for that very elusive catalyst. You already point out we've been range bound for now over a month and a half. Volatility in oil has come back down to pre-COVID levels. And I think to the upside, we're looking for obviously visible evidence on some inventories in consuming countries as a result of, as we were talking earlier, OPEC plus efforts or recovery in the economy. Of course, any breakthrough in phase 3 trials in the vaccine is going to have an anticipatory effect in terms of how people cohesion, discipline in implementing these voluntary cuts. So far, Saudi Arabia has been very good at managing their cohorts and keeping their promises.
I'm trying to work out what happens with jet fuel, Harry. You get a vaccine, demand can come back really strongly, but it's a really hard one to call, and the timing is very, very difficult. What do you see in the jet fuel curve? What are people talking about in terms of how they're going to manage that volatility?
I think as far as leisure travel in general, and also business travel, even if we develop a vaccine, the resumption of air traffic is going to be, outside of freight is going to be slow. I think that the people's way of doing work and conducting business has changed, and there's going to be, of course, a lot of distance in necessarily traveling again that quickly, even as that scenario.
All right, Harry, quick final question here. It is RNC week, so we have to ask you, what happens to U.S. oil production under a Biden administration?
Well, as far as I could tell, just looking at sort of the campaign as it's been developing, Joe Biden is going to be looking at investing and spending a lot in green energy and creating obviously jobs within that sector. But I have yet to see from the Biden campaign any development that could be punitive for the U.S. shale sector. So I think we'll see measures that could be impacting the shale industry. Now, of course, under a Democrat administration, you're going to have to roll back on some of the deregulation that we had under the Trump administration and exclusion of drilling in certain areas.
BNP Paribas, appreciate your time. Now let's get a check on the Bloomberg First Word News. Here's Rebecca Gupta.
Thank you, Kaylee. In Wisconsin, the governor now declared a state of emergency. There was a third night of police shooting of a black man. Businesses were vandalized and buildings were set on fire. Beijing is set to buy a record amount of American soybeans this year, which is the baseline year. I made a mistake. Stephen Hahn spoke 2 days after substantially overstating the benefits of an experimental plasma therapy for coronavirus patients. Hahn says he worries that his mistake will hurt the public perception of the FDA. He also said the agency would not rubber stamp a vaccine. More than 2,700 journalists and analysts in more than 120 countries. I'm Rebecca Gupta. This is Bloomberg, Guy.
Brilliant, thank you very much indeed. Kelly just asking about what a Biden administration would mean in terms of a change in the energy mix in the United States. Coming up, we're going to talk about the impact that Melanie Nakagawa, Principal Capital Director of Climate Strategy, joining us next. This is Bloomberg.
As America fights against coronavirus vaccine trials, the key to a vaccine for the coronavirus.
There's been a big rush to try to put vaccines in place. There are more than 35 candidate vaccines out there today, several of which are already or just about to be tested in human. Vaccine development is really interesting, and it takes quite a long time. You have to develop candidate vaccines, you have to test them in animal models, and then you move them into humans. This has been expedited for coronavirus because China very early on published the sequencing of the virus, and that helped really move things forward more quickly than it might have otherwise. But then you have to take these vaccines that you feel are potential and test them in humans in what are called phase 1 trials. That's when we look particularly to see if those vaccines are safe. Once you get the safety, you move on to phase 2. Phase 2 take easily to the tip.
Some things you see coming, some things you don't. The trick is to be ready for it. Infrastructure support is working every day. Keep on, so you can keep on.
Live from New York, I'm Haley Lyons with Johnson in London. Our Steele is on a well-deserved week off this week. This is Bloomberg. And Guy, if there's a vaccine, and we're getting some crossing right now.
Moderna saying that its
Is Bloomberg. And Guy, if there's a vaccine, and we're getting some crossing right now.
Moderna saying that its vaccine does stimulate an immune
This week. This is Bloomberg. And Guy, if there's a vaccine, and we're getting some crossing right now.
Moderna saying that its vaccine does stimulate response from a vaccine. Moderna now saying that its vaccine, which remember is a messenger ribonucleic acid, is basically using the body's
against the virus is front and center at the RNC this week. It is day 3 of that convention. Vice President Mike Pence is scheduled to speak tonight. And of course, one of the core issues in the White House race is the future of American energy policy. Well, yesterday, Bloomberg spoke to Dan Brouillette, U.S. Energy Secretary, about energy independence. Take a listen.
We've done a great job in America of increasing our production, making ourselves energy independent, relying on new technologies or new, to allow us to increase production of these resources here in the United States. And I think it's important that as we do this, we maintain our posture in the world as the #1 producer of oil and gas. And the reason we'd like to do that is because it gives us more policy options.
Well, joining us now is Melanie Nakagawa. She's Principal Secretary of State John Kerry and was Deputy Assistant Secretary for Energy Transformation at the U.S. State Department. So, Melanie, thank you so much for your time. Given your background at the State Department, you're the perfect person to pose this question to.